Welcome to another weekly market insight where we sift through the noise to get to the signal to give you actionable advice so you can make informed decisions. Joining me this week is Chris.
Hello.
We're going late because of the waiting for the FOMC. We extended an invitation to Jerome Powell, but he did not accept.
A little busy.
I guess he's a little busy. A lot of questions today. So why don't we just dive right in and just start with our price points. Now this was as of yesterday close, so it's not including today's movement. A lot of movement, especially at the end of the day.
Yeah, pretty interesting pattern. So if we go looking back at the same pattern that happened in the last Fed meeting, so mid-March, March 15th, 16th, I think was the date, market was really selling off heading into it, preparing for some bad news. And then they delivered remarks and market shot back up.
Sure.
Something very similar to what we saw today. Now the rebound today was pretty large the last couple of days, not as high as we saw, but we are seeing a similar technical pattern than we saw at the last Fed meeting. Once we just get news behind us, which we'll talk about later on, and markets recovered. S&P was up 3% today, up to 4,300, and then NASDAQ 100 was up 3.4%.
It's good to see green, and I know it's we've been in a technical oversold position for some time. So we were due for a rebound. It's a question, I guess, in everyone's mind: is it sustainable? Is it going to continue to go? And we'll get into that. But if we look just over the last week on just the style, whether it's mid or small or large cap, growth, value, or core, for the week it really didn't matter. Everything was hit last week, down more than 3% across the board. If we look at quarter to date, you start to see some discrepancy and some differences where growth really is taking it fairly hard relative to value. Everything's in deep red, but then if we look to year to date, man, what a difference. Value's down 5.5%, while that growth side, NASDAQ is down 20%. I mean, it's in a technical bear market. And this is some of the things that we've been fighting against for quite some time, coming out of 2020, going into 2021. We looked more like that growth side. We were very heavy growth. We've had to fight, add, and what we've talked about is take cyclical off, add things that are defensive, add things that will hold up, more value tilts. And really over the last, I'd say, couple of months, we've been very similar to the benchmark. So we've looked a little bit more like value, especially in those qualified accounts where there are no tax implications. We're not trying to work around the gains we have in Amazon and Google and others. We could just go straight to where we wanted to go. So that's helped take some of that edge off. But then whenever we start to look in, well, what's driving this? Can you give us a little update on earnings?
Earnings are pretty average. They're okay. So we've had about 55% of the S&P report. That's number of companies. As far as the weighting in the S&P, it's actually more than 50% because the big tech names that make up 5% all reported last week. And if we look at the center left of here on this chart, you'll see that 80% are coming in above expectations. So that's good. That the 5-year average is 77%. So on average, we are doing better, but the beat percentage above historical is only about 3.4%, when historically the beats are closer to 9%. So things are looking okay. I know we said a few weeks ago we wanted to see that 5% was what we were looking for, so we are coming in a little bit below what we were expecting.
And then another chart, I saw this in Natixis, it was great. They're looking at the NASDAQ. That blue line is the earnings growth, and then you see the forward PE, the trailing PE. Basically, we're seeing a sell-off while earnings have been continuing to climb. For the NASDAQ, it's been 3%. Yeah, the NASDAQ's basically in a bear market. And then the S&P 500, it's over 5% on the earnings growth, but you can see those multiples have come back. So it's not an earnings recession. It's not an earnings problem. It's a multiple problem. And we've been talking about this, why we started to become more defensive in portfolios and taking some of that beta off, or being extra cyclical, having more volatility to try to get some upside when the market was moving up. We'd said we'd see some contraction in multiples. We'd see that the price that you pay per earning begin to decrease because interest rates is just a math formula. And we can see right here it's inverting the 2-year yield to maturity with the PE rate, and basically they go lockstep with each other.
Yeah.
So what's driving this right now, what's driving the correction, is multiples compression
which
for
is,
stocks.
Like you said, additional higher rates on discounting and that fear that growth is slowing or trying to price in.
There's a lot of guidance that's really getting pulled back. And then, so if we start to look at what's worked well, consumer staples has worked well. We've added those to the portfolios. Energy has worked well, as well as some of the things like real estate, things that have a lot of stable income. Earnings are pretty much the same. But then when we start to look at price to earnings, we start to say, well, the things that we're hiding in out, everyone else is now hiding in. and they're actually overvalued relative to their average. So consumer staples, which, yes, their earnings didn't change much, but it hadn't grown much. Why are they the ones trading with the highest PE? So that's something that we have to consider as we go forward from here. We're going to get into to that. But why don't you talk a little bit about this slide?
Yeah, this is the saying, sell in May and go away, and we've all probably heard that. And this is just showing why you've heard that. If you look at 6-month rolling periods, May through October, they're the worst periods you can have. While on average it is positive 65% of the time, the average return is only 1.8, which is significantly lower than other time periods, which is over 7. So when they say sell in May and go away, they're referencing this. This is going back to the 1950s. But if we actually look at the last 10 years, this has not held. Sell in May and go away, the average return was 5%, 5.7%.
And really, even if you were to say, well, 65%, most of the time, it's not 50-50.
Right.
More times than not, you're wrong. It's just like how much, I guess, is the question on the sell-off.
And it's just a seasonally, it is a rough period, and we obviously have had an awful start to the year.
Yeah.
S&P down over 13%. And to get a year that started off over 13%, you got to go back to the 30s. It's never a good sign.
You never want to talk about the 1930s in the stock market, right? So it's rough. But
so it's a rough start, but the next question is it normal? And what kind of pullbacks do you traditionally see? Well, on average, a pullback here, looking at the diamonds are where's the pullback during the year, and the blue bars are the returns for that year. Well, right now, if we stopped the drawdown, we'd be average. So it's really, if we continue from here and the drawdown does get deeper, we will be in an abnormal year where it is the pullback is a little more severe. But if the recovery holds, which we did see today, and if that does continue to hold, it's just a normal year of volatility. So
then let's just take a quick snapshot of what's going on globally. I don't think this gets enough attention. This is the COVID situation in China with additional lockdowns. They're locking down cities, and a city in China is the greater population than many of the states here in the U.S. So it's a big deal. There's a lot of shipping containers that are not going out, a lot of factories that are not having a lot of output, all of which will put issues on supply chains. So continue to struggle with these supply chain issues. And then I think most are familiar with this because this has been in the headlines a lot, which is really this commodity crunch, energy, fertilizers, precious metals. There's a lot of things that are not happening because of the Russia-Ukraine conflict. So that's also putting a big hamper on the economy due to supply chain constraints.
And to the supply, referenced in earnings earlier, Apple reported good numbers, and the stock was up initially from the report, and then they come out saying, well, we think we're going to miss out on $4 to $8 billion in sales because of our supply chain issues. Right. So they're still having that problem. Right.
So there's a supply component. But then there's the other thing that there's some clarity on today, and that's one of the reasons that the market has moved up. Not because the Fed came out and they're saying, hey, no, we're just going to continue to be accommodative. Everything that was expected happened, and that means that there's no new surprises that were unexpected. So then the market's rallying off of that because some of this uncertainty is out. But I would really say the Fed has painted themselves in a corner through this situation, because if they were to raise interest rates, we're likely to go into a recession. And by the way, We'll talk about the FOMC minutes, but that's basically what they said they're going to do, is they're going to raise interest rates. They could have kept the interest rates just where they are, and we would likely have moved into stagflation, especially if those supply chain constraints are not resolved. Or they could have lowered rates, and then inflation really would come up. Now, a lot of news is talking about the first quarter GDP. For those that don't know, we had a negative GDP for the first quarter. That means the economy shrunk. And what the thing that we're noticing is a lot of pundits, whether it's at Bloomberg or it's on any of the business news channels, they're saying, well, no, ignore that, because what it was is it was a strong dollar, and that imports. So if you look at the equation,
sorry to cut you off before jumping in. Recession is 2 negative quarters. Right. So we're already halfway. We're halfway there. Right. That's why this matters. Right?
Yeah, that is why that matters. But if we're looking at GDP, gross domestic product, and we look at the equation, it's consumption, it's investment, it's government spending, it's exports, and then you subtract imports. Now the imports that we brought in over the last quarter, it was a big number. So people are saying, well, really the economy grew, it's just we brought in a lot of imports. Look at that equation. But it's measuring.
And they say get rid of that number.
Get rid of that.
Don't even look at it.
We saw whenever it was President Trump, his whole plan of growing the economy is just let's not import anything, and you make that M go away, and obviously the GDP has to go up. It's not that simple. This is a simplified equation, and a lot of people are getting this wrong. And why do you even need to back out imports from domestic production? Because the imports are actually in the C, the I, the G, and the X. Those are all factors that are being imported in. So to figure out what we produced here locally, you have to then take them back out. So it doesn't matter if the import number is big or small, it's the same size on the other side of the equation. It'll always net to zero effect on the domestic production. And to give an example of that.
Because we're trying to measure what was produced domestically.
It's domestic production that we're trying to measure. To give that an example, let's say our economy is that of we just make sandwiches. And we sell a sandwich for $5. That's our economy. And whenever we look at it, the lettuce, the cheese, the bread, those are all made here. And obviously the assembly of the sandwich is also made here, and we get a profit. But we import the salami, and that salami is worth $1.50. So we have a $5 sandwich. We have essentially $3.50 produced here in the United States, and we have $1.50. Now, to try to itemize that number and break it out for the overall economy would be really difficult. So instead, what you say is, well, we sold a sandwich for $5. We imported $1.50. So we actually produced $3.50 worth of economic production in that quarter. So you can see that the import, it's just they're on both sides of things. So we're not having... We wouldn't have had a growing economy if you take the imports out of the equation because it's elsewhere in there. So that's just not how the equation works. And I got an axe to grind on that. You want to talk about
so
dollars?
Just where the dollar has been. So this is 4 charts of the dollar. And looking in the top right, this starts when the Fed started to really say we're going to take inflation seriously. So back in November, they said we're going to fight inflation. So obviously it took some time before they actually did anything about it, but they started talking about it. And this is the dollar index, so it's a dollar against 6 other currencies. And so we pulled the pound, the euro, and the yen, which are the 3 largest currencies in this index, just to show well what's been happening. That white line, the vertical line we drew on these charts, is to also say, all right, well here's the long-term chart, but here's when they did start to actually say we're going to fight inflation. And that's very supportive for the dollar when the Fed starts increasing short-term rates. And that's what we see across the board. So the dollar against the yen, dollar is appreciating. The euro against the dollar, euro's down, and the exact same thing with the pound.
Which, once again, going back to the previous, that can increase imports because it's cheaper to buy things. But once again, that's not going to have an effect on what the domestic production is going to be. We're just going to import more things, and hopefully we can use them to create.
So where do we go from here in terms of GDP?
Yes, so it is a murky path ahead, and we have one negative quarter of that was a real shrinkage of the economy. I know Powell was on there saying the economy is strong, and certainly you can point to metrics and measures that would say that we are strong, unemployment's low, etc. But GDP coming in negative tells me the economy shrank. So it's a murky path ahead. And they had the choice of inflation, recession, stagflation, and in my opinion, they are choosing recession. And it's actually the correct choice here, especially whenever you look at what the policy of the Fed is. They need to have a stable value of the currency. They need to maintain that purchasing price of the currency. That's their goal. So I would say they are going to raise rates, and we are going to see a recession. Probably halfway through that. How severe, how mild, is it going to be a soft landing, a hard landing? All of these things are going to be discussed. But
do you want to go through some of the I sat through the whole call. So
yeah, go ahead. Okay. Absolutely, talk about it.
So we had a 50 basis point increase.
Right.
That was what the market was expecting. That we had increased rates 25 basis points at the last meeting. And so when that gets announced before the press conference, it wasn't a market moving event, fully priced in. And then they get to, well, what are they going to do with the balance sheet? Well, they're going to start rolling off bonds slowly in the next 3 months and then doubling it after 3 months to exactly the number they said they were going to in the March meeting. So that gets released. The market doesn't move. Then Powell starts his address, and he actually addresses the American consumer and basically apologizes for inflation, says, we know you're feeling it. Comes off very hawkish. The market starts selling off thinking, well, you are going to fight inflation too hard. And then what what really stopped the sell-off and really drove up the market 3% or more from there is when he said, we are not looking for 75 basis point increases going forward. So they said, all right, next few increases are going to be 50 basis points and 50 basis points coming in the next two meetings. And the market liked that. That was below their expectation, basically admitting, he didn't say it, but basically admitting the economy's strong, but we're only going to go through with these if the economy continues to be strong.
Right.
And the market thinks, well, the economy is going to be weakening, so you're not going to be that hawkish with the rates. But they are still going to be increasing rates.
Right. And a big word, a buzzword, is that there wasn't expeditious. That was what everyone was talking about, meaning that there is some dovish component to what the Fed is saying. The question is, what do we do going from here? Because it's likely, at least in my opinion, that we are going to raise rates. We're going to let the balance sheet run off, and we are already in an economy that is shrinking. And now we're going to have higher interest rates relative to the last quarter. If rates are higher, you're going to have less economic activity. We still have supply chain constraints, and it seems that there's a lot of pessimism that's getting into the market. We still do see some loan growth, but what we're going to be watching and how we're going to be handling it, this is an internally created graph, and it's mapping the money supply relative to where it was last year, the yellow, and we're looking at just the S&P, and there's that line right there, 5%. That's a warning sign for us once we're under 5%. So we have been mainly focused on getting into funds that are doing better or positions that are doing better than their benchmark, but we also compare that to cash. And it's now the case that they may be outperforming the S&P 500 benchmark, but both are underperforming the T-bill, or really kind of a cash proxy. If we continue to go at this slope and this trajectory and we're moving towards 2%, we don't start to see that money supply stabilize, we'll begin to start to raise cash within the investment policy to become more defensive. We've talked about being defensive, but really what we meant was taking some of the edge off, bringing our beta down, going to consumer staples, going to some things that would hold up and weather a downturn a little bit better. You'd still go down. But at this point, if the Fed's raising interest rates starts to really cause that money supply to slow any further, we're going to go ahead and start raising some cash, especially in the qualified accounts where there's no tax implications to do so. The other thing is the Fed is raising interest rates. One of the risks that you have is that you miss out on a move up. And we've had a strong move today. A lot of that is just people feeling better about the situation, some of that uncertainty. Without a robust monetary policy here, we're just not going to have a sharp V recovery out of this. It's going to be a slower pace. So if we continue to go down in this money supply and we move to cash, we should have plenty of time to get back into the market if things start to improve and get better, and we're not going to miss out on much of an upswing. So it's definitely a different market that we're moving into now, and it's going to take some different strategies to invest in this market. And I would say that this market has been a very, very difficult market to invest in. You have inflation high while the market's selling off, and there's no place to hide, including bonds. If you have any questions, obviously feel free to reach out to us. Reach out to your elite advisors. You can call in the number here or go to the website and request a meeting with them. We're also happy to take any questions at any time. If you haven't subscribed yet, go ahead and click down there and hit that subscribe button. And I think this is an important video. Please share it with those that you know are interested in markets, because this is a difficult market to invest in, and I think there is prudence in being cautious here and being defensive in those portfolios, and people probably need to hear that. We really appreciate you tuning in. Hit that like button if you enjoyed this call, and we'll see you next week. Thank you for watching. Be sure to like the video and press the subscribe button right here so you never miss an update. If you have any questions or would like to get in touch with an advisor, click the link in the description below to request a meeting. We'll see you next time.